Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng, that's down almost 2.9%, almost 3% in trade. Taiwan index, that's down 1.75%.
Equity markets sold off and the close finally. S&P was down about 1.6, NASDAQ down about 2% or so.
I think it's very difficult for both parties to walk back from it.
The Nifty 22,400, so it's 170 odd points down. The sensex is down 500, 73,726.
I think most of the companies will refrain from giving guidance in this uncertain environment.
To reduce the policy repo rate by 25 basis points to 6% with immediate effect.
The big overarching headline is that Trump's sweeping tariffs have come into effect.
China is not naive when it sees that the U.S. has confiscated the reserves of several countries.
Would you want to give the bankers some comfort zone like that? My liquidity threshold is 2 lakh crore or some percentage of deposits.
1.5% is quite a plausible, real rate or a natural real rate.
Now, the point also is this: if China decides to sell, US of course hurts.
The Dow futures, though, have recovered substantially from the lows. They were down 900 at one point and now trading in the positive territory.
Okay, last hour before a trading holiday, which I think everyone is looking forward to with some gusto. Much needed. Markets are exhausted. I can say I am exhausted, and I think most of my co-anchors are exhausted as well. But we have to get through the next 1 hour. Markets doing much better. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, Nigel and Rima with me today. Guys, hi, good afternoon.
Hi. Afternoon. You know what I was thinking? Typically, you always have this counter on, right? Like you've got so many working hours left, and then you've got, a longish weekend, a holiday for 3 days. So I thought if you have that in 1 hour today, and then Friday you've got to work, and then off till Tuesday.
I'll tell you what, these truncated weeks would have been much better for investors, traders, if it wasn't for Mr. T, right? But now you need to keep an eye out on the screen as well, find out what he's saying next. But as you said, Rima, in the next few trading sessions, I think we're working less and we have, a larger number of holidays. It's always good.
Tomorrow is a
right?
holiday,
Yeah.
Monday is a holiday.
Yeah.
So you basically...
And the next Friday is a holiday.
So basically you come in on Friday and then you come straight on Tuesday.
Or you can just come back.
Someone's got a plan on fine.
All right. Well, enough about holidays, but I think that's essentially the state of markets, right? Absolutely frayed and exhausted. I think, we're exhausted commenting on what's coming because it's so much is coming in terms of news flow, reporting essentially on it. And of course, if you're in the market and if you're active and if you're trading, it of course has been exhausting as well. But much better screen on headlines, on headline indices, and basically, as you can look at the Nifty, it's a 0.5% cut, much better compared to the rest of the world in that sense. And it's been that way actually from the morning. So no point was it looking like, like a 2-3% down day. Global markets, by the way, also are off the lows in their own. They're still worse off than India, but they all are off. Of course, tariff headlines remain paramount. That one headline from China, that white paper, and them sort of seeming conciliatory and saying, well, let's talk, etc. That basically caused a bit of a recovery in US futures. Declines outnumber advances 2:1. So market breadth is not all that great. PSU banks, IT and metals are the big losers. FMCG is the sole sector which is higher at this point, and we'll talk about FMCG more in just a bit. None of the levels, and the levels all remain the same on the upside and the downside. We're basically in that range. None have been hit, at least not so far. Rima.
Well, markets are relatively well behaved. The Nifty, the mid-cap index has recovered 1.3% from the day's low. The small-cap index in the red, but again, off nearly 1% from the day's low. So it staged a bit of a recovery as the second half of the trading session has progressed. A quick word on the way Asia closed. The Taiwanese markets ended with a cut of 5.8%. The Japanese index lower by 3.9%. And now on a year-to-date basis, These two indices are down more than 20%. On one side of the Atlantic, the DAX and the FTSE, all three of them down between 2 to 3%. Sweeping tariffs come into effect. For so far, it was talking about the threat of the tariffs. Now we're looking at the impact of the tariffs. So Europe is down between 2 to 3%. On the other side of the Atlantic, we've got the Dow futures, which is currently down close to about 250 points. Sectorally, IT continues to bear the brunt of the selling pressure. The Nifty IT index is down 2%. This month, it's down 12%. Pharma continues to see some pressure. The Nifty Pharma Index 1.5% lower. FMCG, that's the lone warrior in the green. Names like Britannia, Nestle, HUL, Tata Consumer. Top 4 Nifty gainers are all belonging to the Nifty FMCG pack. And then you've got gold loan companies like Muthoot Finance, a bit wary and a bit nervous ahead of what might come out later today in terms of guidelines.
Well, that's right. And I think a couple of stocks, though, that are moved to the high point of the day in this bleakish market setup. You have IDBI Bank that suddenly spiked up. The volumes are very, very large in that one. Currently, that one has moved to the high point of the day. The intraday chart will tell you the picture. Wasn't doing anything much. And suddenly there's a big volume spike on that one. We'll find out whether or not there is any kind of news flow. For the time being, Mitesh Thakkar is waiting by. Hi, Mitesh. An hour before we get into that holiday, and we have expiry as well that will play out. What's the call? The Nifty is down 150 points. You need to take on both, though, that the Nifty actually has been a relative outperformer amongst the global markets as well. What's the level you're looking at?
So I think if you look at the daily movement today, both the Nifty as well as the Bank Nifty, I think, post that opening, I think it started to contract a bit, and the indicators which were on the, suggesting rising volatility have also started to turn sideways and flat. My idea is that I think we might now look at some kind of a sideways ranged activity developing because the directional index, the directional indicators are losing steam. And on the Nifty, I would look at 22,250, 200 as the downside and 22,600, 700 as the upside range. So broadly, I think that's the kind of boundaries I'm looking at. Similarly, on the Bank Nifty, it's about 50,000, 50,100, roughly about 50,750, 800. That should be the area for the next few days before some kind of a clear directional bias emerges. On the stock side, I have one buy and one sell. MGL for me is a sell to stop at about 1270. Would look for targets of around 1200 over here. And MFSL, I think, that's a stock which is trading near the day's high, and there's a pivot at about 1165, only 4 or 5 rupees higher from current levels. So buy about 1167, 68, keep a stop at about 1150 and look for targets of 1200 plus.
Okay, all right, got that. Well, just one stock I want to highlight, Mastech. That's up closer around 15% as we speak. I'm looking at an article online, Rima. I think the UK government is looking to invest 760 million into new health data devices. So I guess that's the reason why that stock has moved. And it's moved on very, very large volumes, currently up at the high point of the day, up 15%.
Indeed, Mastech gets a lot of the revenue from the US government. NHS in particular is a big client. UK. What did I say? US. Sorry, from UK. So the street is watching for this one.
All right. Well, I think let's talk about that. One sector. Actually, it's just one stock where the impact is being seen. I'm talking about Muthoot Finance, right? And this is the RBI policy. The policy, of course, was largely in line with expectations. It's not really been able to move markets except the gold loan stock, Muthoot, on the downside. Ritu is here to tell us what the RBI said and what is coming. Ritu, over to you.
Well, Prashant, the gold loan revised draft rules are expected later today. But, here's what we know so far on the back of which these stocks are reacting. One, RBI said it is going to comprehensively review the existing guidelines and come up with a new draft circular that is also going to, cover conduct-related issues. I'll get to that in just a bit. The idea, it said, is to harmonize regulations across all regulated entities, keeping in mind their own risk-taking capabilities. And the governor clarifying the idea is not to tighten regulations, but to rationalize them. And that, that is something that sort of helps some of the stocks recover later in trade. The draft guidelines are going to be issued for public comments today, and then the final guidelines will be framed. Now, what are these shortcomings or conduct-related issues that RBI is talking talking about. If you remember, in September when RBI had come out with some, sort of guidelines on the gold loan circular, it had said it had observed shortcomings when it comes to third-party use for sourcing of these loans, the valuation of gold being done sometimes without the customer being present, weakness in monitoring the loan-to-value ratio, which is 75%, incorrect application of risk weights when it comes to assessing gold loans. So there were various irregularities that RBI had spotted, and perhaps those are some of the things that it will look to sort of, clarify on in this new circular. Also keep in mind that gold loan is the fastest growing loan segment across any category. Now, it is classified under the personal loan segment, but as of the latest data from RBI end of Feb, in the sectoral deployment, you'll see gold loans grew by almost 87% over the previous year, while the industry average credit growth rate has been 10-11%. So perhaps that's why you're seeing RBI act on that segment. Now, secondly, on the co-lending arrangements. Now, so far, the 2018 and the 2020 RBI guidelines on co-lending only dealt with co-lending arrangements between banks and NBFCs limited to the priority sector. Now, what the RBI is proposing to do is broaden the scope of the guidelines, so include all regulated entities, which means that regulatory grey area that existed when it came to co-lending agreements between two NBFCs or two banks, that will be addressed. And banks can form these partnerships beyond priority sector loans as well. So the idea is to just broaden the base. Again, just a reminder, both are going to be draft guidelines. There will be public comments that will be sought, as is the case, before final rules are spelled out.
Okay, all right. Thanks a lot for that, Ritu. Well, let's get in Prakash Diwan to give us a take. Hi, Prakash. Good afternoon. Good to see you win. Well, Muthoot today at one point of time was down 10%. From there, it staged a bit of a recovery. It's the leader in the pack, and if there is any kind of movement in the organized players, then it always is the largest player. It always stands to gain. But in uncertain times, it pulls back a little bit. So going by the kind of growth outlook, going by the return ratios as well, do you think it's favorable at around this 2,100 odd mark?
Good afternoon, Nigel. So, very clearly, this is one player that's weathered many storms. I don't think you need to kind of be worried about how things will pan out. It's too early, it's too premature to assume that it will be negative or unfavorable. And that's exactly why that 10% lower circuit to the current levels, the move that you saw after the RBI governor's statement. It's very clear there's a huge market that's opening up on gold loans. Muthoot, Manappuram, some of the banks have helped formalize that. Now it needs to get standardized. So there's a lot of subjectivity in the approach that is taken. And I think the RBI is probably looking at, as Ritu also explained, more of rationalization, making it much more objective, transparent, and fair to the consumer. So, all of that behaves very well for the largest player. And to be honest, at this level, you don't really see much of a risk. Whatever impact was to happen has happened. And in fact, it could only be more favorable than what most of us anticipate. And it's not, you could buy it after the announcement, but idea is that if you want to participate in this segment, it's probably one of the best proxies. Or you take up a bank which also is very aggressive, like Catholic Syrian, to some extent. Even SBI has got a very fast-growing portfolio, but then the other things move it in a very different way. So I'm sure people who want to allocate could probably do it to a bank which is leading the way in terms of this thing, or even Federal Bank. All of their gold loan portfolios have started inching up very, very distinctly. So I'm quite positive on the space. I wouldn't be in a hurry. Let's wait for the guidelines to be out, and then you can take a call. From a longer term, Muthoot definitely stands out as one of the better ones.
Prakash, can't not ask you about IT. Once again, it's the top sectoral loser. And today, Jefferies has slashed the target prices. We're talking about cuts of about 25, 30, 35% on some of these best performing stocks. Just pull up the target price picture by Jefferies now. On the large cap space for Wipro, their target price is down from 310 to 210. That's a 32% fall. On TCS, their stock price, the target price has come down by 27% to 3,300. On mid caps, target price cut on Emphasis, Coforge. These were some of the stocks that the street was betting on hopes of a higher growth, and now they've lowered the target price significantly. LTI Mindtree has seen the sharpest fall of 37%. According to Jefferies, the stocks which are best placed are companies like Infosys, where you have some growth visibility, companies like Sagility, which are least exposed because they get 100% of their revenues from pharma, though pharma now is also going to come under the, perhaps come under the ambit of the tariffs. But they like Infosys, Coforge and Sagility. They've downgraded TCS today to a hold because of limited growth. They've downgraded LTIMindtree and Emphasis on account of its high discretionary exposure. But Wipro is the one which is taking a knock today. Wipro is downgraded to an underperform, and their target price of 210 still implies a cut of about 11% from the current levels. Look at the growth estimates that Jefferies has put out for Wipro. In FY26, they're saying the company will degrow, minus 0.5%. In FY27, the top line will go up only 1.7%. There will be margin pressure and the EPS growth will be 2.2%. So they've assigned a target multiple of about 16 times for Wipro. But this is a company which, according to their forecast, will only grow 2.2% in terms of an EPS growth. So, Prakash, with that kind of, growth forecast, what does one do with the stock?
So brilliantly summarized, Rima. I think even Jefferies wouldn't have been able to explain it so well. But remember, some of these targets that they're talking about, for instance, TCS, is anecdotally, it's already below the target price. So what these percentile numbers tell you in terms of, targets from where they believe, their earlier ratings were, it's probably a catch-up. The reality is that, and this is very funny, we are talking about the US administration, imposing tariffs on the rest of the world, and we thought the rest of the world is crying because of that and is getting hurt. But look at the US market itself. I mean, they are also not benefiting. So absolutely nobody is benefiting from what's happening. And the US environment, when I speak to a lot of people, and not just from the market, but generally citizens out there, it's in a state, it's in the throes of such confusion, such uncertainty, that nobody is willing to commit anything in terms of jobs, in terms of capital. Now, you were talking about tax cuts, which could have helped some of these companies increase their orders and all of that. Nothing of that sort is happening, at least for the next 2 quarters. Unless things change dramatically, I think IT will probably suffer a bit. And I do agree, Sagility as a name, we have discussed this earlier, it's one of the most resilient models that you have. Good pedigree, good client base. If pharma gets impacted, of course, that will also have some impact. But it has pricing power. Let's face it, there's nothing that, a lot of the companies, healthcare companies can do without some of these intermediaries. So I would be a bit cautious allocating money to IT, absolutely. But no hurry to buy into any of these and probably wait for some more time. And results, tomorrow we have results seasons kicking off. So let's see what commentary comes through and give you some better idea of what do I anticipate from these companies.
Okay, all right. Well, Prakash, let's talk about the sector that's making a comeback. The FMCG sector, well, that's outperformed the Nifty this week. And Nuvama has maintained a positive outlook on FMCG stocks, like Britannia. Here's a breakdown of all the key factors. Well, first up, the SkyMat's call for a normal monsoon forecast. Well, that bodes well for agricultural production, which can help keep food prices stable and also support FMCG consumption. So that's point number one. Next up, initially the fear was that the heat wave will have a significant impact on the wheat crop. But the wheat crop is actually better than expected. And if the wheat crop is good, then it's beneficial as a key raw material and also it could help margins going forward. That's for the rest of FY26. The other factor at play, and that's both a tailwind for the economy as well as for the markets and for the FMCG pack as well, which is crude oil prices. That's at the lowest we've seen in the last 4 years or so. That helps in reducing packaging cost, which will directly help in improving the margins for all FMCG companies. And finally, starting from the second quarter of this fiscal, demand recovery is anticipated. And there's a few factors at play. Lower food inflation, which will make products more affordable for consumers. The interest rates cuts, well, that will help in lower EMIs, those that have EMIs on homes, on cars as well. That could free up some disposable income. The salary class as well will benefit from the tax rebates, which will increase their purchasing power. And finally, a good monsoon outlook, well, that's good for agricultural production and also it will support consumer spending. The main risk that Nuvama highlight, though, is that the cost advantages will fully be passed on to the end consumer. That's what could limit any kind of margin expansion that we are likely to see for FMCG companies. So week to date, that index has made a comeback. To give you a number, I think the FMCG index in this week is up close to 2.5%, Well, the Nifty is down close to around 2.5% or thereabouts. So big outperformance is what you've seen in this week after underperforming for the last 7 to around 8 months. Prakash, what do you like from here?
So, Nigel, it's quite interesting. And this is a leverage that our community has. We can start looking at the glass half full the way we want. Use all the factors to kind of support that thesis. And the simple explanation why FMCG is making a comeback is probably within the market, very few places to hide. Farmers also, disqualified given the overhang that's there on pharma tariffs. They are completely internally focused, and consumption is something which will continue because you are all look at what's moving. It's all staples. It's not discretionary stuff that's moving. It's the staples that's moving. And while they speak about wheat being in a benign range in terms of pricing, you have sugar which has gone up. So there could be lots of these things. But given the fact that we've had FMCG not participate at all in the last 2 years in this rally, and of course even the correction that's come in has not been so severe, there is very clear evidence that this is the pocket where most of the large cap buying would happen, given valuation comfort, given the growth trajectory ahead and things like that. So if you have volume growth, margins will at some point in time start following. And this is one pocket where you could actually be completely safe. So, there's no impact of tariff. There's nothing much you need to be worried about in terms of global indices and all of those moves. So that's what's making sense. Anything specific that you want to buy? I don't know. Somehow I personally like ITC. But then when you buy ITC, it comes with a lot of other things as well. Thankfully, hotels is out, but I still feel it provides a very, very decent level of...
Yes. Go ahead, Prakash. ITC is something that you like.
Yeah.
And what about the other one? We're getting into, I'll give you 2 hints. One is we're getting into summer season and barley prices have come down. Which one is that?
No, absolutely. So that is a different discussion for altogether, and I'm sure there's enough salience that continues to be built in there. But
United Breweries.
Yeah. So wines and spirits, beverages. I mean, there's enough that you can talk about. As I said, it still doesn't qualify in staples, Nigel. So that's exactly where I delineated the two.
Right. So ITC is something that you like, and from the FMCG pack, and United Breweries has the tailwinds. Summer, and you have barley prices that have come to the lowest level we've seen in many, many months, which will be a tailwind for them as well.
Okay, I'm watching for Swiggy. Swiggy is higher by nearly 2.5%, and Instamart has launched Max Saver, which basically means that if you order more than 999 rupees, then you get higher discounts. So this is direct competition to Zepto Super Saver plan. And Kotak Institutional Equities has come out with a note, and they say that Swiggy's plan for higher order values, again, above 999, where you will get more discounts, is more aggressive. You're getting more, cheaper. For the same thing, you'll get it at a cheaper rate. So therefore, it's good because it will help in expanding. But the net impact on Swiggy will be negative because of the higher discounts. So the net losses at the bottom line will continue to stay. But that's the update coming through from Swiggy. Max Saver.
I wonder whether people really check. 1,000 rupees is getting me this, 1,200. Do you check?
No.
I don't check. But I don't have any of the Super Saver plans. I don't think... but yeah, it's
so on Zepto, it's not that you have to go to the Super Saver. If your order value is crossing 999, then you can just automatically switch.
No, for example, I've started using, I use, I think, Zepto sometimes. And every time I order something, it says...
It says you can switch to Super Saver.
Which I never do.
That's because you don't want to purchase more than 999, right? But if you have a long
my point is, if you have Zepto and you're using a particular scheme, you won't shift to something else because you wouldn't bother going through the scheme and finding out the details, etc. So it's kind of sticky in that sense. I mean, but of course, I mean, it does make a difference for sort of newer markets, etc. I guess we'll try and get the companies back on to talk about this competitive intensity. We've touched upon this with Swiggy, etc. Earlier. Maybe time to get them back. We'll take a quick commercial break here. We're going to come back in just a bit from now. Vaibhav Sanghvi of ASK Hedge is going to be with us on the other side. Stay tuned.
Welcome back. As trade war tensions between US and China escalate, there are possibilities that China may hit back by selling US bonds. Prashant has now moved over to the big wall for an explainer.
Well, thanks very much for that. Will China hit back at Trump's tariffs by what some have called, actually a guest in the morning called, the nuclear option, dumping US treasuries, but they're US bonds. It's the most powerful financial weapon in China's arsenal. There's growing chatter that China may retaliate by doing this, not just with words or counter tariffs, but with real pain in the bond market. Such a move could serve as a powerful financial market deterrent, much like weakening the yuan's daily fixing. Lower yuan makes China's exports more competitive. Selling US bonds will raise the cost of funding for US government and send a clear message. You sell more bonds, yields go up, and that's essentially your risk-free rate. So cost of financing and rolling over US debt becomes much higher. Of course, the message is going to be that don't test our restraint. Now, how big is China's holding of US government bonds, right? I looked at the numbers, and the numbers I have is this. China holds about $760 billion in US treasuries. That's about 9% of all foreign-owned US government bonds. This is down from a peak of 28% in 2011. So this is not a percentage of the total US treasuries outstanding. This is a percentage of what foreigners own, and foreigners own about, as the graphic says, 30% of US treasury debt. So 9% is what China owns. Selling US bonds hurts China too, and that's the problem. And that's why many are saying, they won't do it. It's simply because they are the largest holder, and a fire sale would devalue their own reserves. It's quite similar to how in stock markets we say large shareholder selling, and that crashes the stock because they are the big supply, and there is no counterparty on the other side. One other line of thinking is this: why sell? If you look at the maturity of bonds which foreigners own, 60% of foreign holding of US government bonds are in the 0 to 5 year tenor. So they're not long dated. And I'm assuming these numbers hold true for China official reserves as well. So the thinking is, they could just simply let this run down without reinvesting back in bonds or buying new bonds issued by the US Treasury. In any case, if you look at Chinese reserves over the last couple of years, and not just now, one thing is clear. They're buying more gold and they're buying lesser of US bonds anyway. And this has been happening already. Now, while we're only talking about China for now, the bigger sort of longer term question is this: will we see overall foreign demand for US bonds, US government bonds, permanently impacted, caused by all this, for the lack of a better word, nastiness on tariffs and trade? And I think it's an important question to ponder over, because US government finances a lot of its spending through this route, and people queue up around the world, or rather for the decades now have queued up around the world to buy this because it's considered safe and all the other reasons which go with it. The Chinese central bank, the PBOC, People's Bank of China, has a publicly stated goal in any case to diversify its reserves, move away from the US dollar and reallocate into other G10 currencies. This pivot makes more sense now in any case, even if he did not have a trade war, because the rate differential between US and the rest of the G10 countries is narrowing. So the attractiveness already, that gap is narrowed quite a bit. So it's a space we need to watch closely. As that statement just a while back said, that white paper, apparently they're ready for negotiation, and that's the route this will take, and it won't come to this. The point is this: they don't even need to sell it. If it comes to this, we're not talking about a wholesale sale. There's no buyer on the other side. The Fed will have to do QE and bump up all these bonds if China decides to sell and hand over dollars to China. We're not talking about that. But the point is, even a small, chunky sale could make the point in this trade war that we will match you in escalating this war step by step. And I think that's what we are looking at here. Let's actually welcome in Vaibhav Sanghvi, who's now with us to run us through what he's making of things. He's CEO of Ask Hedge Solutions. Vaibhav, beyond the big picture but it's all big picture now, and not very many people are looking at sort of bottom-up stories because everything is being brushed aside in the same color. What are you doing, Vaibhav, at your fund? You guys can do long, short. What's the sense, and what are you up to?
Prashant, I think markets in a way are extremely kind of volatile in the sense that every day is a new day, right? At the end of the day, what are the developments? and what is the subsequent impact in terms of the portfolio, it's extremely tricky to kind of take a medium-term view on that. So, from being a long short fund and having the liberty to kind of go on the opposite direction as well, kind of helps us to kind of hedge the portfolio effectively during these kind of time periods. But when I saw what you had to mention about the China thing as well, I think one of our contention also is that on the trade tariff, it is not only about tariff. I think a lot would go also into in terms of the negotiating kind of deal, in terms of course, bridging the trade gaps, but two, in terms of the geopolitics, and three, in terms of kind of funding the US deficit by buying more US treasuries as well. So my sense is basically it will be all part of one big negotiating deal, which will come about with all the countries going forward. So interesting times, tricky times, but at least in the next couple of months, I think the turbulence will continue to be there on an overnight basis.
You were talking about your long shots, Vaibhav. Which side, how you're positioned currently, and how has it changed, say, in the last couple of months or so?
See, I think over the last couple of months, I think we had written a note in terms of what we are thinking in terms of the change. And of course, one of the big risk factors was Trump tariffs in that. But what we are seeing, from FY26 and 27 perspective is, one, from a domestic side, we are extremely positive on the whole consumer segment. Now, it's not only about the defensive nature of the consumer segment, but also because that we have seen after 8-9 years of government's sole focus on the supply side to now a combination of welfare and in terms of the consumer rebates as well, in terms of the tax. So what we do think is that increasing the disposable income in the hands of the consumer at the end of it will see to that the momentum in spending kind of increases, and especially into sectors where there are good experiences, or probably going to restaurants, malls, and over and above some amount of discretionary items as well. Lastly, to be followed by the staples. So all in all, the whole consumer space is something which we are bullish on. And at the same time, what we are turning a little kind of to neutral from being very positive is basically the banking sector, purely because as we look at rates kind of come down, we may see some amount of pressure on the margins. And as we see the turbulence on the economic side, where the exporters will have some tough time, maybe probably some amount of stress on those kind of books as well. So that's a segment which we are currently getting neutral from being bullish, from a portfolio perspective.
Any sectors which you're short on, cautious?
So all the global sectors, including metal mining, probably also on autos who have a global exposure. I think those are the sectors which we are avoiding. And lastly, I do think that if the global growth is going to weaken, then it will have a direct impact on the cap goods industrial side, as well. So industrials is something which we should probably avoid as well, purely because the valuations there are not cheap in any case.
And IT pharma? Vaibhav?
Yeah.
You spoke about export-oriented sectors like metals or global companies with auto companies with a global facing. But what about IT and pharma?
See, IT, I think it has been beaten down really badly, and probably we are looking forward to the next 10 days in terms of the results and the guidance. Not that it would be anything kind of exciting. What we may probably happen is basically because of these results and the guidance, we may find some amount of bottom happening post the declaration of numbers. So let's wait for that. In our view, when the free cash flow yield kind of starts to look pretty attractive on these companies, there is some amount of bottoming will be made probably in the next 10 to 15 days. So we will have that view. Pharma is, again, wait and watch. Let's see what happens from a tariffs perspective, and then we'll probably take a call on that.
I think I just saw Coforge up on the screen. Coforge high was about 10,000 rupees. It's fallen to about 6,000 rupees. And Rima, I think I remember speaking to Sudhir Singh.
Yeah.
He's
very bullish.
He's like front foot and everything first, right? I mean, But I don't know if the commentary has changed. The last time, of course, this was all not there, this tariff talk, etc. So we've seen very, very sharp falls in that sense. And tomorrow, of course, we'll ask TCS, I mean, you know, what are they hearing? And if they're able to, if they've heard anything so far, and I think that should set the tone beyond the numbers for Jan to March. Vaibhav, any thoughts on OMCs, oil marketing companies? Again, you know, oil prices have come off very. The only thing is, marketing margins are very robust right now. Will oil stay here? Because in COVID, there was real demand destruction, right? Right now, the destruction is mostly financial markets. So the price of oil can also swing sharply based on what happens to financial markets.
Of course, Prashant, I think while that's a second order or third order probably impact in that sense, but what we have seen in terms of increase in excise duty by 2 rupees per litre, in our view, you know, the OMCs may not be allowed to make profit in excess of a certain amount, which probably will have to be contributed to the government coffers in that sense, which is to build up some amount of cushion on the fiscal spending side. So my view is that as oil keeps on correcting, while we see some amount of decrease in prices on the consumer side, but some part of, again, will kind of keep on chipping you know, away to the government kitty as well. So in that sense, yes, current profitability looks good, but you know, as global growth weakens, refining margins will start to come under pressure as well.
Okay, all right, so not a positive look. I think there was an Ambit note today. They are talking about between 50 and 100% upsides here for oil marketing companies. Sort of in the morning, look for it. But I mean, there's a fair bit of interest here, especially now with that marketing margin story, oil prices dipping, etc. But as Vaibhav said, there are the margin. Of course, we'll have to wait and watch if the government takes away more, leaving less for the companies themselves. Stocks are higher at this point. I think HP, etc., are up to 2.5%. Glenmark is the other one. I think it's down, but I think from the lows, I think it's come up a little bit. Let me just quickly pull this up. And there was some news which came through as well. Yeah, it is off the lows. The low was about 1340. Stocks at about 1375 now. From 230, it's bounced, I think, after that news flow. Vinny is here to tell us what has happened and to kind of explain what this means. Good, bad. Vinny, over to you.
So for Glenmark, mainly the news flow that has come in is that in March, they'd done some recall of 39 drugs, and this was a newest class, and the classification that came in for these drug recalls was class 2. Now, a recall of these drugs was initiated in March, like I was mentioning, and they classified it as class 2 just yesterday on April 8th, and that is why we are highlighting this, and it becomes important. Why? Because what does class 2 indicate? That in class 2 recalls, normally these products are causing some bit of an issue in terms of medical front, which are reversible for in terms of adverse health issues, so you can reverse it in terms of that. But it's important because this could cause an inspection in the Pritampura facility for Glenmark Pharma is what analysts are highlighting. Most of the drugs, yes, were expiring in March 2025, but an inspection is a possibility that could come in here, and that is a concern, and that is why we saw that dip coming in for Glenmark Pharma. As of now, in Q3 FY25, 20% of their revenue contribution came in from the US market. This drug was recalled in the US market, and that is why we're keeping an eye out on this one.
Okay, all right. So it's negative, right, Winnie?
Just negative for that.
At the margin, the perception is that
reasonably negative.
It could cause an inspection. Okay, got that. Thank you very much for that. That's Glenmark for you. We'll take a quick commercial break here. On the other side, we'll tell you what to buy or sell today for a reverse trade when we come back. Day after that is Friday. Stay with us.
Overall geopolitical context. So we're actually quite optimistic on that outlook, and we did not make any adjustments to our plans.
All right.
Welcome back. Select stocks, though, have bounced a little bit from the lows of the day. I think NMDC should come up for you. That's cut its losses. Hindustan Copper as well, that's halved from the recent peak. But that stock as well is spiking up a little bit. And Angel One, just pull up the intraday chart out there. That stock, in fact, has done pretty well. It's done a bit of a U-turn, currently moved to the high point of the day. So individual stocks doing a thing of their own. Mitesh Thakkar is back with us. Mitesh, fresh calls you have for us?
So I think, as I said, trading would be best served if you take it on individual stocks. The indices are showing signs of, consolidation as the volatility indicators have started to shrink. So I have a BTST on NBCC with the stock at about 86 or 85.90 and look for target of 88. And the other stock I would want to buy is Nestle. It's just at the 200-day average, which is about 23.50. And the stock is trading around 23.45, 46. So if it in the next few minutes starts getting past 23.55, buy, we'll take a BTS with a 20-point stop loss. I think this is heading towards 2,400 points.
All right. Thanks very much, Mitesh. Speak to you soon. Mangalam caught up with the Indigo CEO, Peter Elbers, to talk about the growth, the airline, international expansion plans. He began by asking how the industry is dealing with trade uncertainties and how that is sort of impacting flyer behavior. Listen in.
Underlying fundamentals of the Indian market, I think, are very strong. And with that, we're very confident that our growth path will continue to be there. One could even argue with some of the relationships between India and other countries, and recently a huge European delegation was here, is strengthening given the overall geopolitical context. So we're actually quite optimistic on that outlook, and we did not make any adjustments to our plans.
All right, so you haven't made any adjustment to your plans. The domestic market in India is fairly strong. You have a strong international aspiration as well. 40 destinations in FY25. How many more in FY26? And what proportion of your revenue do you expect should come from the international operations over the next 3 to 5 years?
Well, it's a good point. I think India was to some extent underserved, and a lot of the hubs were actually placed outside the geographical scope of India itself. So clearly the ambition of Indigo is to make sure that a lot of that international travel is actually traveling on an Indian operator, and that Indian operator being Indigo. So we moved in in a time frame of just 2-3 years from 20ish to 40 international destinations. We've doubled the number of international routes from 60 to 120. I do expect for the next year in the range of 10 new destinations to be added, more routes also to be added. And the revenue percentage today, or I should say the ASK percentage of production, we've reached the 30%, and we've recently said that that number is going up to 40% of our operational basis.
Let's talk a little about Indigo's business itself. The fourth quarter, how do you think the volumes have panned out for you? Have you met the guidances that you've had? And for the next year, what are your targets and aspirations?
We've actually presented a quite optimistic view on how India is moving. And if you look to the public DGCA data for the month of Jan and the month of Feb,
yes,
they actually look very, very positive and reconfirming that growth. So the underlying demand and the underlying dynamics are good. So we have been able to live up with our capacity guidance. I mean, if you take a ballpark number for aviation, and I would guess for hospitality, it's not dissimilar. GDP times 2 in a market which is underpenetrated. So if we take that 6 to 7% of GDP growth, which is taking place in India, you have a kind of figure where the growth is ended. For next year, we estimate, again, a early double-digit growth number going forward.
One of the concerns that everyone had was these airports increasing their charges. How do you have to respond to that?
Airports increasing their prices, it's a matter of a discussion taking place in India and outside India. I think where I would like to sort of engage in a discussion with the airports, if the average prices in India are 6,000 rupees for a ticket, you don't want to have airport charges of 3,000 rupees, right? And that's exactly where I think we need to find a good balance between what is the price point for customers and what is the airport charges. So that's a continuous debate. Having said it on a more positive note, the quality of airports in India is getting better by the day, and that's a very important aspect.
Well, important conversation over there. The Nifty is at that 22,400 mark. The low today was 22,350. So that happened at about 11 o'clock. And since then, especially the last 2 hours, we've moved in an absolutely flat line. 22,400 down 130 points. Get into a break. We'll come back and chat with Ambrish Palika. Welcome back. The benchmark indices are likely to go home with a cut of close to about 0.5%, reacting to perhaps what you could call the tariff trauma. Tariffs, Wall Street's reciprocal sweeping tariffs have come into effect right from Algeria to Zimbabwe. On China in particular, it's 104%. So most of the global markets are weak in trade. Indian markets, no exception, but the cuts are not deep. And in that, we forgot that RBI provided a boost. They cut 25 basis points of a rate cut and changed their stance to accommodative, but not too much of an impact given the global uncertainty. Amrish Baliga is now with us on the show. Amrish, before we get talking about today's market, first tell us your stock.
The stock of the day is Astral. It's among the leaders in the building materials space with presence across pipes and adhesives. In the last few years, they've entered into other segments like paints, faucets, sanitary ware, bathware, water tanks, and valves. And they've, in fact, been the pioneers in India as far as CPVC and lead-free UPVC pipes and plumbing systems goes. They have about 25 manufacturing units spread across India, around 3,300 distributors, about 230,000 dealers. And they've been expanding on a continuous basis. In fact, the current capacity utilization is just about 60%. So there is a decent headroom. In the last 7 to 8 quarters, the top line growth has been in single digits, but the margins have been maintained, but still the stock has corrected quite sharply. And when you talk to the management, they're still confident of about 15% CAGR. As far as revenue goes, basically because the real estate and infra spaces are doing decently well. Government focus is there on various schemes like Pradhan Mantri Krishi Sinchai Yojana as well as Nal Se Jal under that Jal Jeevan mission. It's a net debt-free company. They have cash on books of about 290 crores. I'm expecting an EPS of about 34 for FY27 and have a target price of 1,700, which is still much lower than the highs which you have seen in the last year and a half.
Okay, all right. Well, just keep an eye on a couple of other stocks. JDL, one of those underperformers, suddenly is seeing a big volume spike, and JDL has now moved to the high point of the day. So let's just get the intraday chart of the stock up. Suddenly moved to the high point of the day. Well, Prakash, Amrish, apologies. I wanted to ask you actually about auto ancillary companies. Right. In the past, we have discussed Motherson, Gabriel as well we have spoken about, and I think Sona BLW as well. The problem is the auto pack has gone into a tizzy. Because of what President Trump is talking about, if there's a recession that hits, then, it'll affect across the industry as well. At current reckoning, post the big pullback in stock prices, what's your top pick?
In fact, my top picks will still be Samadhana Motherson. Which has, if you see from the highs which we have seen in 2024, it's about 50% down. Sona BLW similarly. And I think, this negativity seems to be slightly overdone because, yes, there will be issues because of the tariffs. But then we should keep in mind that these big boys in auto ancillaries have their units in US. So, the hit will not be as big as most of us think it would be because, at least some part of their revenue comes from US and that really will not get affected by these tariffs. Yes, to a certain extent, whatever they're exporting from here, whatever raw materials they're exporting from here to their plant in US, that would be affected to a certain extent. But I don't, the way the stocks have fallen, I think the worst seems already built in.
So we'll have to see when what will cause eventually for this next leg to play out. Right, worst is built in, and then news hits, and then the market starts to look a little better. Some of these stocks start to look a little better. But that's the problem. We don't know what the timelines here are in that sense. Any other individual names, Amrish, which may have been in your coverage? You talk about, we've discussed many stocks in the past as well. And I'm sure many have taken a bit of a hit, maybe some in an unwarranted way. Anything else you want to highlight?
Some of the others in the auto ancillary space where I'm positive is basically Menon Bearings. Again, a small cap. Jamna Auto, they are the leaders in the leaf springs. I think these are two ones where again we have seen a decent correction. And at the current levels, I feel that possibly the downside seems limited from here. I don't know as to when it can start moving up, but if one is a long-term investor, nothing much to lose at the current levels.
Okay, all right. Amrish, in the past we've discussed Hindustan Zinc. I'm just looking at a few of these names. They've got hammered, metals, because it's more global facing as a theme. SAIL has recovered from the day's low. Hindustan Copper has recovered from the day's low. We have JSL Stainless. All of them seen a good recovery. What's the call on Hindustan Zinc?
Hindustan Zinc, I'm still positive on the stock because if you look at the valuation, it's still quite, extremely decent at these levels, especially after the fall which we've seen recently. About close to about 40% of the bottom line, in fact, comes from the silver, where again we have seen some correction as far as the silver as a commodity is concerned, and that's also rubbed off the prices of Hindustan Zinc. But at the same time, we should remember that the sales are completely dependent on real estate, the construction, as well as infra, because end of the day, zinc is used in combination with steel. So I really don't see the demand really going down too much more from here. So at the current levels at 400, possibly a risk is 5 to 8% maximum. Whereas the upside, if things work out fine, the cycle turns, possibly in the next year and a half, I'll not be surprised if you see levels of about 550, 600 plus.
Okay, all right. Amrish, stay with us. We'll continue this conversation a little later on markets forward. Let me just quickly wrap up things. We're about 2 minutes away from closing. And we'll end with a 0.5% cut uniformly on the main indices, except the small cap index, which loses a little bit more. But otherwise, it's pretty contained in that sense. 2:1 declines to advances. The big nifty losers. And sectorally, I think it's easy to count the winners. FMCG was up, everything else broadly lower. In terms of large stocks, Wipro and Tech Mahindra from the IT space took a bit of a knock. TCS, of course, reports numbers tomorrow. SBI and Shriram Finance are the other two names from the financial space which looked up. And there was a L&T and a Trent as well, which were higher, which were lower, beg your pardon. These are the losers. And as I said, FMCG stood out. Nestle, Lever, Tata Consumer were the three FMCG names. And of course, there was Titan, which was higher as well. Muthoot, which was down 10% immediately after that RBI, around the time of the RBI governor was speaking, actually recovered, but then again, it just is about 3% off from the day's lowest level. So to at 21.34 or so on Muthoot Finance. And I think, as Ritu said, post-market hours is when we will get that draft circular come through. The other big losers, Phoenix Limited, Piramal Pharma, Biocon and Walkhard. And there was something like a MGL which was sharply lower as well. A few gainers, there was Mastech, which was up a bit with big volumes, Jyoti Laboratories and Max Healthcare stood out as well. So that's basically the market action this Wednesday as we head into the holiday tomorrow. But before the holiday, there's markets forward. We'll, of course, continue programming here. Stay with us. You'll hear from Ambrish. We'll get you a technical voice as well. Stay tuned.